Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Antony Blinken lands in Tel Aviv as Israel's new unity government signals a major ground offensive will start soon, and investors factor in the cost of a protracted war. Fed officials agree to proceed carefully. Markets now brace for the latest inflation data, which economists are forecasting will show a further easing in inflation. And Republicans nominate Steve Blitz as the next House Speaker. But opposition from a group of hardliners threatens to delay the final vote and leave the chamber without a leader. A very good morning. It is day 5 of the equity market rally. The AAII, the survey of the bulls to the bears, shows a bullishness creeping in. 40% bullish reading on the AAII. You have an official narrative from the Fed, which is to proceed carefully. You heard it in the rhetoric from the various officials, but the minutes confirmed what the officials had already trotted out. Today is CPI day. Will we err to the upside, above 3.6% year on year, or will it be a cool CPI, which will really invigorate the rate cut narrative for 2024? Asia is piping hot this morning, up 1.125%, as China steps in and they spend $65 million on equities in banks. This is the first time that they've stepped in and bought bank stocks in China since 2015. It's not the cavalry coming, but it's about the tone and the message, which is we are here. We are going to defend the system and the banks. Asia Pacific up by 1.6%. The Hang Seng was up. Just reflect on Birkenstock at the bottom of your page, at the bottom of your screen. It tanked yesterday by nearly 16%, 13%. It opened at $41. It closed back 0.4%. And Europe is at a 3-week high. Good morning, Ms. Berger from New York.
Good morning, Mr. Cranny. Look, when it comes to this bond market, let me take you through the cross asset. We are pausing after the gains, after the rally we've seen of the past 2 days. Perhaps it is this anticipation of CPI, which you laid out, Manus. Perhaps it is a hotter PPI yesterday that sent the front end of the curve up to 5%. It backed down from that. So perhaps that helped reinforce that the sell-off, maybe it's back in store. Maybe we started buying bonds too soon. Brent crude, that completely erases some of the gains that we had seen post the conflict in Israel, post the attack. Brent crude, for the moment, it is moving higher. It's up 0.9%. That is due to the fact, likely, that we saw a show of unity between the Saudis and the Russians appearing on Russian state TV. Meanwhile, the Bloomberg dollar spot, it is down for a 7th day. Manus, it is headed for its longest losing streak in just over 3 years, very closely tied to the bond market story. And Manus, on that point, we've had weeks and weeks of discussing the bear market steepening, how odd and how forceful it has been. For those who have made money, maybe now it's time to cash in on the profits. A great story on the terminal about Schroeder saying they're closing most of their trades. Now the question is, do you go outright long bonds as the Fed looks to be nearing the end of its hiking cycle?
Well, it's certainly going to be the view from a couple of our guests. We've got PIMCO coming up with us in terms of positioning and duration. Now, I just thought we'd pick up from the JP Morgan survey. This, I think, complements what you're saying. This is a ramp higher. It's the largest ramp up in longs in 2 months. 28% of the survey from 22%. So this is about a rising outright long position. And that really underpins the thought in the piece that you've got, Danny, which is those steepeners are done. This market is now perhaps a little bit more interested in being outright long if that recession comes harder and heavier. And then, of course, the CPI readings will inject a new fuel into the Ferrari of rate cuts 2024. Danny.
Yeah, exactly. That is the risk, right, that we get something hotter from CPI and it completely undoes the rally that we've seen so far this week. OK, well, let's just reset. The U.S. Secretary of State, Antony Blinken, has landed in Tel Aviv in the last hour. He spoke to reporters as of last night.
I'm going with a very simple and clear message on behalf of the President of the United States and on behalf of the American people. And that is that the United States has Israel's back. We have the back of the Israeli people. We have their back today. We'll have it tomorrow. We will have it every day.
That was Blinken getting onto the plane. Bloomberg's Oliver Crook has now arrived in Tel Aviv. Oliver, good to have you with us. What is the latest on the ground? Good morning.
Right, Manna. So it's been a really very packed 24 and 12 hours, really. So we have the unity government. We can get to that in a little bit. But in terms of the military operations in Gaza, we've had a number of briefings from Israeli defense forces. So we know that they've continued to hit significantly on Gaza overnight and that they have been striking the Gaza Strip. There's a new death toll there of 1,200 people. Electricity, water, food are in scarce supply there. So humanitarian issues. We also know from them that there are 300,000, as many as 300,000 ground troops that are amassing near Gaza that are ready, they say, to move if there's going to be a ground invasion. However, there was a briefing earlier where they said the politicians have not yet made a decision on whether or not there will be a ground invasion, but the military stands ready. It is obviously, Manus, an event that is much more complicated by the fact that there are 2 million people living there, extremely densely populated, and of course the hostages that Hamas has taken from Israeli territory still in captivity.
Oliver, what can we expect from Blinken's visit?
So he arrived just now. He will be meeting with Netanyahu and a number of others. And again, we heard him in that soundbite, really support for Israel and support that Israel needs politically, globally from the United States, particularly if they're going to wage a land war in Gaza, but also support that they need militarily. We know that they got some equipment yesterday, but they need to replenish the Iron Dome if there are more rockets to come in, particularly if there is a ground invasion. And then there is more tension on the northern border with Lebanon, with Hezbollah, of more rockets coming in. We also know that Blinken will go to Jordan tonight. He will meet with Mahmoud Abbas, so also some diplomacy on the cards.
So, Oliver, you mentioned it at the very start. There is a new government of national unity. Yesterday, we heard the central bank governor will stay on. So this is about all the bodies of Israel uniting at the moment, isn't it?
Completely. So every government official will hold their position. Anything that was going to change is going to stay in place for now. All bills will be tabled that have nothing to do with the war. This is a war government, Manus, and this is a war government that is composed of, yes, the defense minister presided over by Benjamin Netanyahu, but also the opposition, the former defense minister and the leader of one of the opposition parties, Benny Gantz. And this is really coming after a very intensely fractured Israel. I was here 6 months ago, and every single week you had over 100,000 people in the streets that were protesting the Netanyahu government. That has evaporated. It has really coalesced in a message of unity in Israel.
Oliver, thank you so much for that. That is Bloomberg's Oliver Crook reporting from Tel Aviv. All right, let's take a step back and talk about Fed officials because they have agreed policy should remain restrictive for some time, according to the minutes of their September meeting. Boston Fed President Susan Collins spoke about how the Fed is now approaching monetary policy.
In my view, this transition to a more patient approach, taking the time to holistically assess incoming information, was warranted for a number of reasons. In particular, it reflects the fact that we're likely very near and perhaps at the peak for this tightening cycle, with the risk of inflation remaining persistently high more closely balanced with the risk of slowing activity more than needed to achieve price stability.
Collins adding to the voices of many like Jefferson, Bostic, Logan, saying that the market has done the work for them, kind of having that similar peak language. Joining us now is Nicola Mai, Sovereign Credit Analyst at PIMCO. Nicola, great to have you on the program.
Good morning.
You and the team just put out some really fantastic research about where we are in this cycle, your cyclical outlook. In that, you said recession risks appear to be higher than the market is pricing. What then needs to catch up or catch down?
I think you summarized it well. I think markets are way too sanguine about the economic outlook. I think risk assets are pricing an immaculate disinflation type outcome in which growth remains solid and inflation falls towards target. In our mind, the picture is darker than that. We think that the fiscal sugar rush that has been supporting growth will fade. Monetary tightening will kick in, and we think recession risk is quite a bit higher. So risk assets really look vulnerable here.
Nicola, good morning. That's a fairly malevolent landscape to paint. With that in mind, how does that bear on the rate cut narrative? The Fed has guided to 2 rate cuts next year. If the landscape is as malevolent as you paint, will we see more accelerated rate cuts than we are presuming at the moment? They're telling us higher for longer. You're telling me something different.
I think a couple of rate cuts by the Fed, which is what's priced in the market, is probably a reasonable assumption. I think the key point here is that I think rates have peaked, not only in the U.S., but also in Europe. And I think inflation is going in the right direction. Growth is moving down, and I think that should really very much anchor bond yields, which we find really attractive here. So I don't think it's as much a view about the Fed cutting more than the market, but really the peak in rates anchoring fixed income valuations.
The conversation, though, from the Fed, even though some of them are talking about peak in rates, has been higher for longer, though. They're kind of pushing back still against the market narrative of cuts. Does that mean they're heading for a policy mistake if they're keeping rates restrictive for longer?
Well, I think central banks are really willing to accept the economic weakness that is coming because inflation has been a scare. It's been higher than it's been in decades. And I think central banks don't want to make the mistake of easing policy too quickly. And so I think higher for longer will last for the next few quarters. But obviously, the economic risks are going to be rising. And I think the possibility of a hard landing on tight monetary policy and fiscal support fading are significant. And that's, again, where bonds offer good value.
OK, so they'll eventually work as the hedge that they're supposed to be. They haven't done quite what they're supposed to do for the past couple of years. Contrast that with, I mean, you're a buyer of bonds, but you are wary of credit. But I look at what Howard Marks is saying to me at Oaktree, and he's saying, credit gives me equity-like returns. It probably represents a substantial, or should represent a substantial portion of the portfolio. Of course, he's speaking his book. I get that. But you are a little bit more wary on corporate credit, given the recession risk. So are you decrediting the book, or are you just taking less risk across the spectrum?
Well, I think if you think about credit, the duration component within credit, the risk-free component is attractive. If you look at the spread, meaning that how much you get on top of the risk-free rates or the duration component, to me that looks quite compressed. Equity valuations are obviously very elevated, but also corporate credit spreads are quite tight given the economic outlook. So we do want to take risk, but in a defensive way in credits where we feel, we are protected. I mean, think about agency mortgages in the U.S., for example, government guaranteed, really interesting spreads, and also a lot of structured products, securitized assets, senior financials to some extent. So you really want to take risk in a defensive way from our perspective.
When you are looking at some of the riskier spreads, I mean, as you said, they haven't blown out like they have in prior recessions. Do you expect this to be a typical cycle in that way, to see spreads, I don't know, getting to 2,000, a pretty hefty default type cycle?
So our baseline is not a deep recession. It's a mild recession, and there's or stagnation/mild recession. And the reason is partly that household and corporate balance sheets are in pretty good shape, and partly because financial stability policies have been very proactive. I mean, think about the UK LDI response, or the FDIC in the US guaranteeing bank loans, bank deposits. So not a deep recession, but still a recessionary environment, and I think spreads will widen from here. It doesn't mean they will go to very wide levels, but I think mark-to-market investors should be cautious here.
I'm kind of torn between China stimulus and Japan, but I'm going to go with my gut, which is Japan, because we've had everybody on going max bull Japan, max bull equities in Japan, bull yen, because they believe YCC will be ripped apart sooner than we all think. How much of Japan should be in the portfolio now? What is your starting point for YCC being removed, and how much allocation upping are you doing to Japan? Are you taking more exposure to Japan?
I think that's a really good question, and one of the themes we mentioned is monetary policy divergence, and really Japan is going to be diverging. Most central banks are going to be cutting rates. We think that in the coming quarters, Japan will fully exit YCC, and also they will raise the policy rate in our baseline outlook. And as a result, I think our inclination is to be underweight Japanese duration. As I said, we like duration in the US, in Europe, also in places like Australia, New Zealand, Canada, where rate sensitivity is high. Japan, I think you want to go in the opposite direction.
Okay. Nicola, thank you. Unfortunately, we have to leave it there. Thanks for joining this morning. That is Nicola Mai of PIMCO. All right, let's get you caught up on some other top stories that are trending on the terminal this morning. And as Manus mentioned, China's wealth fund has boosted its stake in the nation's big four banks for the first time since 2015. The wealth fund says it also plans to buy additional stock over the next 6 months. The move comes as a growing number of Chinese economists and hedge funds call on the government to directly intervene without a stabilization fund for its customers.
And Caroline
and
Ellison.
Caroline Ellison, Manus, you take it away.
Yeah, she took to the stand, Denny, for the second day yesterday. Star witness in the fraud trial of Sam Bankman-Fried. Ellison choked back her tears as she described the final moments of FTX, and Almeida reflected on all the damage that had been done. Damage, she said, that was done by Bankman-Fried's behest.
Now, over at Ford, it's become the latest strike target for the UAW after members walked out of its largest plant, a highly profitable pickup factory in Kentucky. Ford called this surprise walkout by 8,700 workers, quote, grossly irresponsible, and says it poses serious consequences for suppliers, and customers. Manus.
Well, coming up, Republican Steve Scalise has been nominated to become the new Speaker of the House, but his fight for that title is far from over. We discuss. And later this hour, we catch up with Steve Blitz, Chief US Economist at TS Lombard, on the shifting odds of a recession. He's calling for 6.5% in Fed funds. Has he shifted? Good morning from Bloomberg, New York. Bloomberg Brief. I'm Manus in New York, Danny Berger at London HQ. Well, the Republicans have nominated Steve Scalise as the next House Speaker, while the GOP majority supports him. The looming fight over his election risks delaying the U.S. response to the fiscal deadlines and to the new war in the Middle East. Joining us now is Kate Ackley from Bloomberg Government. Kate, the numbers, this is all going to come down to a small group of people in the Republican Party who hold the power to fill or kill his bid. So talk us through how close we are to electing a speaker.
Well, it's good to be here with you. I mean, it feels like Groundhog Day or some, we've been through this before. It's a lot like January when Kevin McCarthy was trying to round up the votes. So now we have Steve Scalise, who's the Republicans' pick. He's trying to get the votes. But it was a slim, behind closed doors, secret ballot election that where Republicans in the House did pick him. But the votes for him on the floor are not certain.
Yeah, I mean, he can't lose more than 4 GOP votes? Kate, that's such a thin margin. Can he get them?
We've already, been sort of tracking a whip list, if you will, and there are more than 4 that say they won't vote for him, including last night embattled New York Congressman George Santos said he would not vote for Scalise. There are a couple of, hardline Republicans say they won't vote for him. So he has his work cut out for him.
What has he got to offer those 4/5 holdouts? I mean, McCarthy, they say, offered a lot of deals. Some say he reneged on them. That's why they took him down. So what is it you think that Scalise has got to offer to the minority to get him over the line? I mean, he's been endorsed by Jordan as well, hasn't he? I mean, Jordan got 99 of the 112 votes that went against him. So what's he got to put on the plate?
Well, if he's got to be careful. If he gives up too much like McCarthy did, he's going to be right back where McCarthy was, 9 months later, losing the speakership. So he has to be very cautious about giving in to any sort of deal making or making side deals with individual members of Congress. Yes, Congressman Jim Jordan did say that he would endorse Scalise for this role, but that doesn't mean he's bringing along all of his supporters. Some say they will not vote for Scalise.
And Kate, quickly here, I mean, there's this new sense of urgency. They can't conduct any business, including aid to Israel. The Biden administration is considering combining that aid. Quickly, would that bring GOP opponents of Ukraine funding along?
It's a risk. It's a risky strategy, potentially. It could bring on some Republican opponents to Ukraine aid, but it could also lose support among some of the more progressive Democrats who oppose, giving more aid to Israel. So it could bring on some, it could lose some. But by bundling them together could be a risk. And we were watching, last night, former President Donald Trump criticized the Israeli government. So will some other Republicans in Congress, be taking their cues from him and could support Wayne? We don't know, but it's something to watch.
Okay, Kate, thank you very much. Nail-biting stuff again. We're back at the brink for the GOP. Kate Ackley there, Bloomberg Government, tracking Capitol Hill. We'll return with more news on apartment prices in New York. You like that on Bloomberg. This is Bloomberg Brief. I'm Menace Cranny in New York with Danny Berger in London. Danny, there's a number, $4,350. That is the median rent in New York. Apparently, it's down by 1.1%. Danny, I want to know where all the incentives went. There's a broker out there that got me my apartment. Max rent. I arrive in New York. I am calling the peak in New York rents. Isaac Rosenberg is the best. He's the richest broker in New York. No wonder he turned up with a gift last week. Right?
What a call out. I find this so sad because we're like, oh, the market's coming down. It's only come down 1%. It's still over
every 1% matters,
as you said, for the medium rate. I don't know, man. I'm going to time, whenever I move back to New York, the bottom of this market. So at this pace, you're still not going to see me for like another decade. I don't know.
I just want to know where they got this line that there were incentives to lure new renters. You haven't met the condo board that I had to divulge my life savings to them to actually get through the door. This is not the
if
truth.
Anything, it's the other way around. You had to give them incentives to take you on. All right, and it's coming up. We're going to speak with Steve Blitz, Chief US Economist at TS Lombard. This is Bloomberg.
Welcome back to Bloomberg Brief. I'm Menace Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Antony Blinken lands in Tel Aviv as Israel's new unity government signals a major ground offensive will start soon. And investors factor in the cost of a protracted war. Fed officials agree to proceed carefully. Markets now brace for the latest inflation data from the U.S., which economists are forecasting will show a further easing in inflation. And Republicans nominate Steve Scalise as the next House Speaker, but a group of hardliners threaten to delay the final vote and leave the chamber without a leader. Man, it's a quick check on your cross asset. We were just speaking to PIMCO, who says the peak is in for growth and for inflation. They want to buy bonds. The market not listening. 10-year yields, they move higher about 1.5% after 2 days of a rally spurred on by both haven bids and some language coming from the Fed, from Logan, from Bostic, from others, saying the market is doing the work for us. We also have a lot of supply coming on the front end. ICAP figures that this is the heaviest week when it comes to certain tenors of different bills. Brent crude, that is up 1 1/3%. It did make this round trip around from the gains that we had seen when Hamas attacked Israel over the weekend. But we did get the show of unity between Saudi and Russia that helped to spur a higher leg in Brent crude this morning. And finally, Manus, my superlative for you this morning is on the dollar. We're on track for the 7th consecutive day of decline. Should that hold, that would be the worst losing streak in over 3 years. I know you like a fun fact.
I love a fun fact, and I'll give you a day 5 for equities on the bid. So we're up for the 5th day on the S&P 500, not listening to the PIMCO narrative that a hard landing is coming. Risk assets are going to be under pressure. It's going to be recession rather than rate cuts that drives that bond narrative. Stocks are higher this morning by 0.3%. Again, the minutes from the Fed proceed carefully. That was the formal ratification of the previous rhetoric used by all of those Fed speakers that you have mentioned. Asia is up by 1 1/8 this morning. The top line for Asia risk and indeed global risk is not that the cavalry are coming from China, but you're seeing their sovereign wealth funds step in and buy bank stocks to the tune of 65 million. So China's sovereign wealth fund steps in for the first time since 2015. Is that a sign of real support or deep angst about the housing market in China? Either way, it has bolstered Asian risk. You need to know that as you look through the rest of the trading day. You are at a 3-week high for Europe. Now, in terms of Louis Vuitton, they had a battering yesterday. Birkenstock, what a flop. Down 13% on the open. That was their nemesis. They're trying to claw a little bit back this morning, up by 0.4% when we last checked in. So there you go. It's going to take a few more than $1,000 Dior Birkenstocks to help that along. But Danny, this comes down to the bond conversation that we're about to have. PIMCO want to be long duration and long defensive around the world. And that is critical to your call on bonds.
It is critical, but it's also critical to your call on equities, that risk markets are just not pricing in what he sees as a recession. But it was, of course, nuanced, Manus. He sees a recession, but it's not going to be doom and gloom. Sure, credit spreads will widen, but they're not going to blow out.
No, and we got the JP Morgan survey showing longs, the biggest long position in the survey at 28%, the biggest in nearly 2 months. So what we've got today is, of course, CPI. That's what we're waiting for, Danny. It's going to hit the tape at 8:30 a.m. Surveillance will be all over it. The estimates show that slowing inflation, so we're looking for 3.6% from 3.7%, will shape the outlook for the Fed. Joining us now is Steve Blitz, Chief US Economist for TS Lombard. Good to see you. We've had proceed carefully. We've been told it by various Fed presidents. We've heard it in the minutes. But you had a call late last week that rates are going to go to 6.5%, yields will go to 6%. Have you shifted, given what you've heard from the minutes and from the Fed voices?
Well, I don't think the Fed is planning on it right now based on the minutes. You know, let's go back over the last several years. How good are they at forecasting anything? Look, I think they believe that we are at this wonderful point of stasis where the economy is slowing in their estimation, that disinflation continues. And that as a result, they can hold at 5.25%, 5.5%, maybe 5 3/4, and let the 10-year do the rest of the work. And this will get them to their promised land of immaculate disinflation and 2%, and that's it, you know. But I don't believe in fairy tales.
I do.
Yeah. I try to pretend I do until something abruptly wakes me up. So in this world, Stephen, what's going to wake us up from the fairy tale of immaculate disinflation? What's the shoe that will drop?
Well, I think it's not necessarily a shoe, but I think it's simply that growth goes on. You know, we're not going to see a recession here in the fourth quarter. It's very unlikely. And with that, the economy... I think what they're going to see is that suddenly, as the year turns, that the progress on disinflation begins to stall. The equity markets are still doing well. Unemployment is still where it is. And they're going to realize that they're slowly, instead of being in a stable spot, they're slowly losing a position. And adding to that, I just want to ask, because you've been talking about bonds, adding to that, you know, the forces that raised the 10-year in the third quarter was $1 trillion in funding by Treasury, net new financing by Treasury, and on top of that, they added about $500 billion to the TGA account. Now, it's subject to change, but at the moment, they're saying they're going to raise $850 billion in the current quarter and only raise TGA by $100 billion. So that means that the Fed's Treasury is going to be adding more money to the economy for the amount that they're funding. So the net of that is that less upward pressure on rates. Now, you don't get that swing again in the first quarter. So you get this moment here for this quarter where things are wonderful, but then all of a sudden they realize where they are come the early next quarter, and they realize that the chase is back on.
So a chase to you looks like yields at 6%. Various people have come on the show with Danny and I, and they've said we're going in for a wild ride in inflation next year. So let's just step back a little bit from what you've just said, which is they're going to be shocked by what happens with inflation. But what is it that's going to drive that inflation spike next year? Because it was COVID, supply chains in the initial COVID period, then it was labor and wages. So what is it drives the coyote moment in inflation next year?
I rather than think of it as a spike, right? Think of it as something which is really much more pernicious to the Fed. A spike is something they can keep looking through and say this is transitory. I think more pernicious for them is just the economy stabilizing at an inflation rate, let's call it 3%, let's call it more likely 4%. Right? That with wage settlements coming in and just the general expectation of the way firms set prices, people expect wages. You know, even if inflation's coming off, most people are still way behind in terms of the level of prices versus the level of wages. There's room to go. So all of that creates a an inflation rate that's stuck at 3-4%. That's the Fed's real fear.
Steve.
Yeah, sure, sorry.
On that, no, you're good. Don't apologize for saying your opinion, Steve. Look, we had a lot of companies, a lot of corporates who gorged on debt in 2021 when rates were low. They were faced then with rates moving higher, but there was always this silver lining that they would come in. If we're talking about a world where inflation stays stubborn above 4%, where are the weak links? Where are we not prepared for that stubborn, tenacious inflation world?
Well, I'm not quite sure I completely understand about where, because you were talking about these companies. Look, if they funded themselves in 21, that debt doesn't roll for 10 years. So they're fine. Secondly, I know, a lot of people talk about the rise in capital costs, which is true. But if you have 4% inflation, remember the revenue side of these companies is higher as well. And one of the hard parts about getting inflation down, and one of the legacies going all the way back to the 70s, which I know for most of you is, I could be talking about the 1870s, but one of the legacies of the 70s is a lot of deregulation and innovation that allowed both sides of household as well as corporate balance sheets to float. And so that, if you get a spike on the cost side from rates, over time the revenue side picks up and vice versa. And so you end up in somewhat similar spots. So, I mean, look, the obvious problems are always commercial real estate. And that's obviously a difficult spot for the economy and for them and their lenders. But I see that more as a long-term drag than something that's acute.
Okay, I mean, look, there's a wonderful phrase from Bank of America where they say, the boa constrictor around the U.S. economy is commercial property. You talk about the longevity, and you have longevity, and you've seen many cycles. What is the problem with this bond market is that there's an entire group of people who've never lived through 3, 4, 5%. Normal inflation to me, and a normal mortgage rate to me, is around 5, 6, 7%.
Right.
Okay. I lived at 15%, but 5, 6, 7% is what I lived with. So this is we're going into a world of new normal, but the Fed hasn't accepted that. They're going for an inflation rate of 2%, so they just must be absolutely wrong then in your case. They should adjust the inflation target. Based on what you said.
They need to keep the inflation target because that's sort of like the gold.
Well, that's the last pillar of credibility for them, isn't it?
Exactly, and that's 100%. I agree with you completely. That's the reason why they're very reluctant to give that up. But you're right, and you see that in the behavior of the behavior of the curve, how quickly it inverted when they just hiked a little bit, and 5s, 10s inverted. There is still within the marketplace, and there will be for a long time. These things take 10 years to work themselves out of the market, but there's still this underlying bet that inflation must return to 2%. And I think, and that's the disappointment over time that the market's going to get to, but we're not there yet. But it's slowly moving, and watching the movement of the curve, especially the long end of the curve, is rather fascinating in that regard.
It is indeed. We've gone from that burst steepening now to people calling for outright longs. Good to have you in, standing by your guns there. I'll leave you with this thought. I got the price of money at LIBOR plus an eighth. You'll never get money at that price again, Steve. I'm about to redeem that mortgage. That is Steve Blitz, TS Lombard, our guest this morning on rates. Coming up, Goldman takes legal action. We'll discuss the bank. It's suing Malaysia. That's next on Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manish Cranny in New York. Manish, we got some breaking lines crossing just moments ago that the UK's FCA, the Financial Conduct Authority, is banning the ex-Barclays CEO Jess Staley from senior financial roles. With that, too, they will be handing down a fine of £1.8 million. Joining us now to discuss is Bloomberg's Leo Kane-Sherper. Leo, how did we get to this point?
Yes, exactly. So Jess Staley stepped down as Barclays CEO almost 2 years ago, and it was already related to early findings from the FCA related to his characterization to the board of Barclays of his relationship to Jeffrey Epstein. And this basically led to him stepping down almost 2 years ago. And now eventually the FCA came out and said, OK, he's banned from working in financial services, and also handed out this £1.8 million fine.
Well, Leo, good to see you this morning, and well done for reacting immediately on the news there. The other major story this morning is, of course, it's been going on for years now. This is Goldman Sachs and Malaysia. Goldman's now suing. What is the background for this, and what do you think Goldman is actually trying to achieve by the move?
Yes, another major scandal, or I should say the biggest financial scandal, one of the biggest financial scandals ever, basically where this development fund has been looted. And Goldman yesterday filed a complaint to the International Court of Arbitration here in London, and basically to settle a disagreement over a payment that was due in August last year. Because as we all might remember, Goldman in 2020 struck an agreement where it agreed to pay $2.5 billion to the Malaysian government and $1.4 billion at a later stage tied to assets that would be recovered. And now the Malaysian government basically disagrees with the amount that should have been paid in August 2022, and now they're at this court.
Yeah, at just one level, it's incredible. We're still talking about 1 MDB in 2023. Hey, Leo, thank you so much for joining us for the latest on that. That is Leo Kane-Sherper of Bloomberg News, tracking the latest financial stories. Now, we're also keeping an eye on a stock that slid almost 13% in its trading debut yesterday. That's, of course, Birkenstock. It buckled, you could say. It was the worst showing for a large U.S. listing in more than 2 years. In fact, only 13 IPOs of that size have fared worse in the past century. The question is, has our reporter stuck around after that terrible pun? She has. It is Bloomberg's equity capital markets reporter, Julia Fioretti. Julia, so was there a pricing issue with this IPO?
It seems that there was, Danny, basically. It was priced quite high, actually, even though it came just below the midpoint of the range. In terms of in comparison to its peers, such as Lululemon and Nike, actually the valuation was still quite high and quite punchy. And these aren't exactly the markets in which one can be taking these risks. And that obviously has been borne out by its performance yesterday. It opened down 11% and then didn't even manage to hold that. It fell further. So it shows that the IPO market is still cautious. There was a lot of exuberance, perhaps, a lot of excitement a month ago, but that has now abated somewhat. And so it's still a tricky market, a market in which valuations need to be tempered somewhat. And investors are still obviously cautious.
I just want to know, I mean, you live in Dubai. Have you been to the Dior store, and have you seen the shoes that are $1,000? We can talk about the broader IPO market in just a moment, but please answer that for Danny and I. Have you been to Dubai Mall, and have you seen them?
No. I have other things to do.
But Manus, have you seen them?
I have.
You're around Fifth Ave every now and then.
I popped up. I popped up to the Apple store the other day, and beside that is the Dior store. And I went in. I said, "Excuse me." I said, "Do you have any $1,000?" I said, "Do you have any $1,000 Dior Birkenstocks?" He looked at me. He said, "No." Let's talk about the broader IPO market. The broader IPO market. I mean, this was supposed to be a big test. We were all bulled up for this. It flopped. What does it say briefly about the broader market?
Essentially that it's still extremely cautious. It hasn't come back. It's not a full-fledged recovery. The uncertainty globally, and the macroeconomic uncertainty, obviously the geopolitical uncertainty now in the Middle East is still weighing on the IPO market, still weighing on investor sentiment. And so it means that some companies might choose to go ahead and they might succeed. The Middle East seems to be bucking that trend at least. But in other markets, it's still a little bit shaky. So it's probably, we're still looking to 2024 for a proper recovery, assuming no further black swan events.
I mean, all I can say is every time now I'm going to see that BIRK ticker, I'm going to be reminded of the fact that Manus Craney refuses to buy me a pair of those Birkenstocks.
I don't even have a pair myself, and I lived in the desert for 5 years. There you go.
We can get some matching Bloomberg ones. I don't know. It can be our thing. Julia, thank you so much. Julia Fioretti there on the latest IPO news. Now, coming up, we're going to take a look at some of the market-moving events to watch throughout the day. But first, a quick check on your markets. S&P 500 futures do climb higher. in opposition to some of the narrative we've heard from PIMCO saying a recession is on its way. Steve Blitz says that inflation and rates still need to head higher. You're looking at your 10-year yields. That is moving higher, just barely, though, not even a basis point, as Brent crude climbs to just above $84 a barrel after making a round trip from the Hamas invasion of Israel. We've had a show of support from both the Saudis and the Russians, that unity helping to lift markets by nearly 1%. More to come on Bloomberg. This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Now let's get you set up for your trading day with a quick look at what's ahead. The European Central Bank publishes its account of its September policy meeting at 7:30 a.m. Eastern. That, of course, follows the U.S. Fed minutes that came out yesterday. Then U.S. CPI, that comes out at 8:30 a.m. Eastern, at a time the Fed has made some progress on tackling inflation, but of course still faces continued risks. And Bloomberg's Screen Time event continues in Los Angeles. Our special coverage today includes conversations with the co-CEO of Netflix and the CEO of YouTube. It also comes at a time, Manus, where those labor disputes with SAG-AFTRA seem to have hit a wall. They've suspended some of those talks. And again, it just adds into this picture of, has inflation been conquered? We're still having labor disputes ongoing.
Well, we're going to wait, and all eyes are down on the CPI. The market batted away that slightly hotter PPI from yesterday. Is the correlation huge or not? Some people say it's not. You can't read PPI to CPI, obviously. But my favorite word, we're 54 minutes, 33 seconds into today's program, is pernicious. Our last guest talked about, T.S. Lombard said, we're going to have pernicious inflation, you're going to have 6% rates, and you're going to have 6.5% in terms of the 6% in yield on the 10s and 6.5% on rates because of pernicious inflation, and it's a mega shift of a mega trend.
Yeah, part of the reason I love that, Manus, is because we have had all these Fed speakers come out, right? Logan, Jefferson, we heard from Daly recently, and the Fed minutes basically saying the market's done the work for us. We are near peak rates. And the market has listened to that. We've seen this huge bond market rally. So it's important to get that point of view. That's what they're saying. But is that what the data says? We haven't seen that yet.
And they're hanging on. It's a bit like me hanging on to an argument. There's blood around their fingernails, really, in terms of hanging on to the debate. Not that we ever have any arguments on this show about what we're going to do. But it's holding on to that inflation target of 2%. What is the reality? Mary Daly moves on the neutral rate. What is the real level of inflation they should be going for? But of course, the cavalry are coming. Who are the cavalry, Danny?
The home team? Is that where we're going? The China home team. Yeah.
That's it.
Yeah, they are buying. They're buying banking stocks, something they haven't done since 2015, following that great Bloomberg scoop, Manus, also of 1 trillion yuan that they'll be spending on infrastructure. It's lifted metals today.
Absolutely. You got metals a bit up. Iron ore, I like that word. Iron ore is up, it's up 0.75%. You got copper running higher on the LME. So that China story is small, but I think it shows a massive level of intent. It's only 65 million from the Sovereign Wealth Fund buying China bank stocks, but it's all about the destination. Danny.
All right, that's it from us. That's Bloomberg Brief. Surveillance is ahead. This is Bloomberg.